The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to this Tuesday edition of Scorebox with Arabina Gamede and myself, Steve Sedgwick, and these are your headlines. So a late rise in big tech pushes the Nasdaq within touching distance of a fresh record high as earnings season kicks off into high gear. SAP lifting its full-year outlook after a top and bottom line beat in the third quarter, driven by a 25% jump in cloud revenues. We're going to hear from the group CEO, Christian Klein, in a first on CNBC interview. We'll do that in 30 minutes' time.
Shipping giant Maersk raises its full-year outlook for the fourth time this year, buoyed by third-quarter earnings beats. And monthly new car sales hit reverse in Europe, with demand for plug-in hybrids now dropping over 20% last month. That's across all major markets.
Well, talking of autos, Hyundai Motor India, look at that, it's down 5%. It wasn't supposed to be like this, was it? Extending declines in Mumbai as the country's largest ever IPO gets a cautious response from investors, especially from the retail sector.
All right, so ultimately this market picture is going to be one to really look out for. And we're going to touch on the Hyundai India story in a moment or two as well, a little bit across the show. But really just the market has been fairly interesting. Yesterday we're getting this mixed tone then out of this market picture. There's still anticipations of maybe further rate cuts. What is very interesting as well is that the commentary then coming out of the Fed is a bit more cautious rate cut cycle from here, at least four Fed speakers as well, just really making note of that then. But you still have a fairly strong economic picture still stateside. So when you have a 50 basis point cut, is that really just out of a necessity really for the economy, or is it to begin to boost the US economy? It clearly didn't need any boosting, but for now you're seeing somewhat of a mixed picture then even across this market as well. A drawdown then from the record levels we've seen over the past couple of days for both the Dow Jones Industrial as well as the S&P 500. The Nasdaq Composite managing to gain around 0.25% in yesterday's trade. It was actually moved high by Nvidia, which moved up around 2.5% as well then yesterday, also hitting a record high in trade yesterday as well. So a significant jump high on that front. So still showing that it does have the muscle to lead this market. Just very interestingly as well, the small caps, the Russell 2000 was the big outperformer yesterday, down 1.4%. Of course, the earnings picture, still one to look out for. We're going to ramp up earnings across the US then in this week. Onto the Treasuries market then. Treasury yields, particularly on the 10-year, look at that, 4.21 then. Not so long ago, we're just holding on to that 4% mark, a 12-week high with a near 11 basis point jump then overnight for the 10-year Treasury. The uptick could still be based off of last week's more resilient data on the U.S. economy as well, which was very interesting to look at. Above the 4% mark as well for the 2-year and the 30-year there, 4.5%. Onto the currencies here, then forex markets mainly tracking what you saw out of that Treasury market, meaning that you saw a lot of the dollar actually moving a little bit higher yesterday, particularly late on, sitting around 108.20 now is euro dollar. So that's within a whisk of the euro's lowest level since early August. You're seeing the yen then above that 150 mark then. So just a little bit of weakness coming through again there, near 2.5-month low. In fact, it even touched that 150 90 point as well a little bit earlier. Analysts suggesting then that the dollar's recent rally reflects markets pricing a possible Donald Trump election victory. Can't call that per se, but one that they're looking out for, because they say that investors may see trade, tax and immigration policies likely to lead to higher inflation as well then as higher yields. Onto the commodities market here then. Oil climbing 1.7% at least then in yesterday's trade, with no let-up then. And of course the Middle East fighting following the death of Hamas leader Yahya Sinwar. Prices are now hovering then still a little bit steady around that $73.96 a barrel, just under $74 then for Brent crude oil. It is down just 0.4% this morning. WTI just hang on to that $70 a barrel mark there. Spot gold, well, more records here, right, that had kept on tumbling yesterday, then hitting just above that $2,740 a fine ounce mark. This morning, yes, up 0.5%. A little bit weaker from where it was then as well in yesterday's numbers. As I said, market uncertainty around elections, even the earnings picture, maybe some more safe haven buying still in that picture. The Asian market, this will be looked at because there isn't too much to talk about when it comes to the earnings, or rather to the economic data points. But of course you have that Hyundai India listing then out of India. So that is a key proponent to look out for in the broader Asian market. But on these big four markets, then you're seeing a bit of a mixed picture then so far this morning. China's markets pinned well below recent highs there, but is managing to still hang on to a gain of around 0.5% so far this morning. The Nikkei 1.4% weaker so far this morning, leading the downturn then across Asia, in fact at its lowest since early October. Onto the European market then, this is what you're bound to see. The FTSE 100 may start the day off with a slightly negative call. European markets closed lower yesterday. Investors taking in some of those key corporate earnings. Of course, we have SAP as well that we'll be looking out. The rest of the market looks like it may start the day a little bit more positively, Steve.
Right, Arabile, thank you. Let's go back to, I think, one of the key stories, and one you've mentioned already, is the fact that the bond market has not cratered, but we've seen a lot of caution coming through and ownership of bonds for various reasons, whether it's coming from the Fed, whether it's coming from the politics, as Arabile mentioned. And guess what, guys? The Fed hasn't got a prescription. And guess what? Also, maybe 50 basis points was the wrong thing. It wouldn't be the first time the Fed had got it wrong. Anyway, we've heard from 4 Fed policymakers on the outlook for rates. Kansas City Fed President Jeffrey Schmidt, the Dallas Fed's Lori Logan, Minneapolis Fed's President Neil Kashkari all used the term gradual or modest to describe the pace of future rate cuts. However, the San Francisco Fed President Mary Daly, the only voting member of the 4, described the current interest rate as very tight. Really? Is she looking at the same labour market I am? Anyway, very tight, saying she does not want to see further labour market weakness. We haven't seen much so far, have we, Ms. Daly? I don't know. Anyway, Apollo chief economist Torsten Slok says there is an increasing chance the Fed will need to hold rates at his November meeting. Isn't that amazing? Go from 50 basis points to hold. Wow. Slok says the US is on a no-landing trajectory, with the economy continuing to expand, and also cited, quote, wide open corporate financing as another tailwind that could push the Fed to pause. Markets are still pricing in a more than 90% chance of a 25 basis point cut next month, according to the CME's FedWatch tool.
Now, Goldman Sachs says it expects the S&P 500 to post an annualized nominal return of just 3% over the next 10 years. That's sharply lower than the 13% average over the past decade. Now, strategists at the Wall Street lender cited the market's concentration in big tech names, saying it will be extremely difficult for large tech firms to maintain high levels of growth for a sustained period. Let's get on over to John Plassard, Senior Investment Specialist then at Maribode Group, who joins us now. Look, one thing is for sure, this is going to be an interesting market from here then, with all the dynamics at play here, John. Do you agree with that sense? 3% then over the next couple of years, having seen what's just happened over the last 10 years? Is that a bold call?
I think they are focusing on the fact that there is you just mentioned before, 23% of the latest bounce has been concentrated in a handful of biggest technology stocks. So they think actually that maybe the bond market should finally pick up and they could give more return than the equity market. And I think that after, the bull market started 2 years ago, and the current bull market is already up 60% for the S&P 500. So I guess that this is maybe one of their call, and they are maybe a bit more cautious about what could happen in terms of volatility after the U.S. election. So not totally agree with them, but yes, maybe a less fantastic bull run, yes, next year. And the coming years.
Yeah, I mean, I completely take your point then, John, but would you not say then perhaps we're getting a broadening out of this market by the looks of it? So it maybe not led by tech, but tech along with the others are then moving higher. Doesn't that actually mean that the market would get more in terms of, or speedier with regards to its uptick?
No, I think that, the question to know if the artificial intelligence, team is in a bubble is the question mark. And I don't think that's true at all. If we look at the projection global market for AI by 2030, it's around $1.6 trillion, and it's expected to grow in the coming years. So I don't think the tech, I would say what people call the tech bubble is behind us. I think that the energy stocks and everything what is related with energy that should fuel the AI stocks and also the cryptocurrency is also a new team that is coming and going around that could bring also some pace to the stock market. So I'm not really sure. I'm quite constructive, honestly.
John, very good morning to you. A couple of questions for me. Are we looking in the wrong place for the destiny of the US Treasuries? We're spending a lot of time talking about policymakers who, quite frankly, can't predict the data any more than the rest of us, it seems, despite their wealth of data points. Instead of looking at interest rates as the driver of the Treasury market, shouldn't we be looking actually at the supply of Treasuries that are going to be on the market, given the extraordinary spending plans and lack of balancing the books, so to speak, from both presidential candidates?
Yeah, I totally agree. I think next year the theme will be, of course, the debt and how should the U.S. government refinance himself. And we know that even if it's Kamala Harris or Trump, it will be the same thing. So, but we see that the direct impact is quite hard to understand, and the economists are more talking about inflation that could be driven by higher debt, higher spending, but this is not the short term. This is more medium term. So I would say that yes, of course, that will be the theme of next year, but will it really drive the stock market more than the Fed policy? I'm not sure, Steve.
See, I wonder if we're beginning to pivot, John, and I know it's something that you and I could have discussed at any stage in the last, 20 years, given these huge deficits that have been run and the way the debt clock has picked up and the way that, regardless of the administration, debts have picked up in the US as well. But there comes a point when the wealth of supply not only affects the Treasury yield and the Treasury market, as you and I just discussed, it also affects the destiny of the equity market. And whilst I see a lot of arguments at the moment about equities up, more caution on bonds, sooner or later that higher financing which comes across the curve for all corporates, for all households, and dare I say it, for the US government as well, that's going to have a ramification for growth as well, and ergo start hurting the stock market, won't it?
Yes, and this is what I just said before. I think it's really the risk of inflation, and the fact is that I think the Fed is rethinking the fact that they might be under pressure next year, so lowering the rate at the pace they're doing right now, and in that momentum, and there was this discussion knowing if they should cut even the rates in December by 50 basis points. That will not be the case. I think there are so many uncertainties, so many things that will hurt the market. But if you look at what is happening now on the Treasury yields, the 10 years, and you just mentioned it before, at 4.20, it should historically hit the tech stock, and that wasn't wasn't the case because the Nasdaq is close to all-time high, and this is driven not by the fear of the Treasuries going up to 5%, for example, but more looking at the growth perspective for everything around the artificial intelligence. So yes, I think it will more have an effect not on the stock market, but more on the way the Fed is looking at the picture.
John, appreciate the time. Thank you so much for joining us then this morning. John Plassard, the Senior Investment Specialist at Maribode Group. Now we'll hear exclusively from legendary investor Paul Tudor-Jones on the market's economy as well as a little bit more. That interview is coming up at 1:30 p.m. London time. We'll also get another take on the market outlook with Trond Grande, the Deputy CEO of Norway's Sovereign Wealth Fund, Norges Bank Investment Management. That interview is coming up at 2 p.m. London time.
And the ECB Governing Council member Peter Casimir, who has been talking about December's meeting, says it's, quote, wide open with all options on the table. Casimir is seen as one of the Council's more hawkish members. Said more evidence is needed before the ECB. Did he not look at the PPI from Germany yesterday? I'm sure he did. More evidence is needed before the ECB can declare victory against inflation. Yeah, your problem is deflation, mate, I tell you. No, I didn't say that. Anyway, let's move on. IMF Managing Director Kristalina Georgieva has warned that concerns remain around the health of the global economy. Speaking ahead of the publication of the IMF's updated global growth forecast today, Georgieva warned that higher prices are here to stay. Okay. And said the world is facing a, quote, unforgiving combination of slow growth and high debt. That sounds good, doesn't it? Not. On a programming note, do not miss our coverage this week from the IMF World Bank annual meetings live in Washington, D.C., where Karen will be speaking with a number of European central bank policymakers and finance ministers, including Germany's Christian Lindner. Tune in for those conversations throughout the week. And we're going to start later today with the IMF's chief economist, that's Pierre-Olivier Gourinchard, to get his latest views on the World Economic Outlook report being released this afternoon. That is a first on CNBC conversation at 1500 British summer time.
Coming up on the show, Disney gives an update on its succession plans and lines up a Wall Street veteran to be board chair. Also ahead, Trump and Harris campaigns are there in battleground states in the final sprint to Election Day. 2 weeks to go on that one. And German software giant SAP lifting its full-year outlook. We'll be speaking to the CEO, Christian Klein, in a first on CNBC interview at 6:30 BST. HSBC has named a new CFO and announced the outline of its restructuring plan. Europe's largest lender will streamline the business into 4 units: Hong Kong, UK, corporate and institutional banking, as well then as international wealth and premier banking. Our company veteran Pam Kaur will take over as finance chief from January, the first woman to be appointed to the post.
So the producer's got a very, very tight hand on the rundown today. Sometimes yes. I managed to kind of break the shackles of the rundown and just go off
your way through in the last
No. She's kind of cracking the whip 100%. A little bit today. And she said, oh no, we want to save time for a Disney chat. And I was like, I'm feeling a Disney chat. And to which the director chips in as well. They're all at it this morning saying, well, yeah, what's your favourite Disney princess? And it was a hell of a conversation.
Yeah, it went on for quite a bit.
The sound desk got involved. They said Cinderella. I said, she's not enough of a modern woman for me.
Why not? Why? I mean, she can't be a modern woman.
Moana.
Really?
Yeah, this isn't a democracy, it's a dictatorship, this show. Moana.
So it's done.
And because it had The Rock as well, and the best songs as well. Disney has announced that, I'll get back on track, that's what Brit wants. Disney has announced that the former Morgan Stanley CEO, James Gorman, will become the company's chairman in January, laying the groundwork for the company to name a successor to CEO Bob Iger in early 2026, later than the original target of a 2025 appointment. Gorman will remain chair of the media giant succession committee, which sources tell CNBC has interviewed all four of Iger's direct reports in recent weeks. What's to say about Disney? Well, had we had this conversation before August, I would say that there are problems left, right and centre for this company as well. On the streaming side of operations, on the film side, let's be honest, it's been a checkered performance from all the big studios over the last couple of years as well. They're just finding it harder to get the big hits as well, and indeed problems at the parks unit as well. Yeah. Now, after the August figures, I think we can possibly reevaluate. They've had a really good run on streaming. Streaming's turned into a profit. They've had a couple of great movies. I haven't seen either, to be honest. Inside Out 2, I saw the first one. My family went to Inside Out 2. They decided to go without me until I was available. They loved it. Haven't seen Deadpool Wolverine, but again, apparently went incredibly successful despite some of the critical reaction as well. So the focus on the problems at Disney at the moment appeared to be perhaps what they're doing with the Marvel franchise. I don't think they've perhaps nailed Marvel and Star Wars at the moment. Pixar a little bit back on track as well. But of course the theme parks, again, aggressive cost cutting perhaps on the agenda, and we've heard a little bit about that as well.
If streaming's coming back on track and they're doing a little bit more there, and then you somewhat take the theme that they're following on from Netflix, which is everything from password sharing, etc. And we saw Netflix actually get a bump off the back of that password sharing element, around 30% or so with regards to an increase in some of its subscriber numbers, revenues also managing to move higher. It could ultimately, I mean, I'm not saying that it's going to be like for like, but there could be some extrapolation to say maybe that bodes well for Disney with regards to that, because streaming ultimately coming back in some way or other there.
Sure.
And then a bit later on in the show, we actually get to speak to Tele2, is it?
Yes.
And that's going to be interesting because they have a Disney Plus conversation going on for themselves too now in Sweden. So it's going to be about perhaps those partnerships, making a whole lot more of those and making them work in different jurisdictions.
So what does the market want? The market loves Bob Iger. It would love him to hang around a bit longer. He tried to quit a couple of times. And of course, Chapek had 33 months, wasn't the greatest tenure going as well. Iger back as well. Would they coalesce around Iger going forward again? That would take a lot of money to persuade him to stay, I would imagine, as well. One more point on the shares. I don't know if you've got a Netflix versus Disney comparison, but obviously incredibly different business, despite the fact they have a lot of coalescing on certain activities, including streaming. The difference between the two is one's a tech company in a magnificent 7, 33 times forward. Disney, more traditional media company, more akin to the owner of this channel, Comcast. Disney trades at around about 17, 18 times forward. So there's a very big gap between the two. One more traditional. Yeah, I mean, although, you know, they were fantastic. Thanks, guys. That's exactly the chart I wanted. And you can see there, whilst Disney is off its lows, again, I would suggest that August data was one of the catalysts there. You can see that Netflix has pulled away aggressively. Yeah. Extraordinary performance year to date. Very much so. I think the most important question, though, is whether you can sing the songs from Moana. I can't sing any songs. No? I don't remember any lyrics. I thought we were going to help our audience just a little bit. No, not going to happen. Moving on. I know you can. I know you no excuse for doing more karaoke. Not even a little bit. You love karaoke. The videos are there online. He's a huge online presence. Streaming those. Right, Vice President Kamala Harris and former President Donald Trump are campaigning across battleground states in a bid to win over undecided voters, just 2 weeks from Election Day. Harris joined the former Republican lawmaker Liz Cheney, who has crossed swords many, many times, of course, with Mr. Trump. They joined each other in Pennsylvania and Michigan, whilst Trump held events in North Carolina and toured the hurricane-hit area of Asheville. NBC's Garrett Hawk filed this report.
Tonight, former President Trump playing defense in North Carolina. He's won the state twice before, but polls now show a coin flip contest.
I will end inflation, I will stop the invasion, and I will bring back the American dream.
Neither Trump nor the RNC chairman saying today they'd seen any indication this election won't be legitimate.
We're so impressed, and I think they have a pretty good system here.
But just hours later, Trump's still suggesting, without evidence, the election could be tainted by fraud.
The vote counter is more important than the candidate. That's been true, unfortunately.
Trump also visiting Asheville, hard hit by Hurricane Helene, where he was pressed about his false claims about the FEMA response and threats FEMA workers have received.
Well, I think you have to let people know how they're doing. If they're doing a poor job, we're supposed to not say it.
It all comes after Trump campaigned in battleground Pennsylvania.
If we win Pennsylvania, we win the whole damn thing, right?
But raising eyebrows with this lewd digression about Arnold Palmer, spending 12 minutes talking about the golf legend in his hometown of Latrobe.
When he took showers with the other pros, they came out of there, they said, oh my God, that's unbelievable. I had to say it.
Trump also holding a photo op at a Philly area McDonald's, working the drive-through window to pre-screened customers.
We love you. Come here, thank you, sir.
And scooping out French fries.
You got the salt on it?
Saying he doesn't believe the vice president worked at McDonald's for a summer in college. Harris responding today.
Madam Vice President, do you work at a McDonald's?
All while Trump supporter billionaire Elon Musk, campaigning for Trump in Pennsylvania, is drawing scrutiny for saying he'll offer $1 million to one random registered voter every day if they've signed his petition in favor of free speech and the right to bear arms.
If you already believe in the Constitution, you're just signing something you already believe, and you can win $1 million. That's awesome.
Pennsylvania's Democratic Governor Josh Shapiro firing back.
I think it's something that law enforcement could take a look at.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.